Sort of a good news, bad news theme on the show for folks today. The good news is, particularly when you're looking at interest rates, my goodness, they're approaching 5% on a lot of money market type of accounts. Make sure you're taking the opportunity to really kind of shop around out there, because a lot of folks still have savings accounts that aren't earning what they should be. Most of that is because the banks don't have to increase those interest rates that they pay on savings accounts at all, really. It's based upon sort of them setting what the interest rate is, and obviously as if they can keep it low, that is to their advantage. So make sure you're checking out the options on that. That's the good news, of course, is that you can actually find some options that would pay a little bit of interest on your savings. The bad news is certainly here in spades as to what that really represents, right? So thanks to higher interest rates, we're seeing interest rates on cash actually be the highest level that they've been for probably 2 decades. In fact, for the better part of the past 2 decades, it's basically been non-existent. But here's the bad news, right? How those higher interest rates that have allowed folks with their emergency savings and their cash savings to actually earn some interest on that is translating into other areas, right? So the higher your savings rate is, guess what? The higher the mortgage rate is. And this past week, we saw mortgage rates really jump up. I think on this past Monday, it hit 30-year fixed rate mortgage hit 7.5%, the highest that we've seen since November of 2000. So that goes back a long ways in terms of what we're seeing happening with mortgage rates. The 10-year Treasury note rose above 4.3%. That's last seen since 2008. So that's certainly the bad news side of this interest rate increases. Mortgage rates and things like that have really jumped up dramatically. Certainly some significant rates that fundamentally impact our ability to borrow money. The longer term impact, if you want to really lay awake at night and worry about stuff, is what the Treasury is going to do. Because during the course of this third quarter, between July and September, the United States Treasury is issuing about $1 trillion in new debt. Guess what? That debt's probably going to cost the old folks in Washington a little bit more because of higher interest rates. It's also going to put further upward pressure on interest rates. So certainly a very important issue to watch, particularly in terms of how that plays out on the finances. One of those interesting things that come as you see the cost of capital increase, and we've been talking to various folks around the office about this concept. You know, when we think about cost of capital, when interest rates are low, cost of capital, meaning, you know, cost of money is very cheap, right? So what that means is that nobody really stops to think about how they're using their money. But when cost of capital, or the ability to access money, access cash, actually goes up, then people start to make very different decisions. And what we're talking about there is that when capital costs arise, sort of non-economic options, and in this case, think silly options, so options that are present and you scratch your head on it, and the list over the past decade is certainly kind of long. You've got your meme stocks, you've got your crypto, you've got your NFTs, your non-fungible tokens. Remember those? Those were the pictures that were going to, be the next sort of U.S. dollar currency trading. SPACs separately, special purpose acquisition corporations, all of that, right? And not really hearing a whole lot of that right now because it's all kind of melted down. And the reason is that, again, when money is cheap, it doesn't cost you much money to get your hands on it, then it kind of goes into some silly stuff because nobody really cares. Nobody's making real decisions. But when you start actually having a cost of capital, 30-year fixed rate mortgage at 7.5%, then you're like, well, wait a minute, that's kind of costly, and I'm going to make sure that what I do with my money is in fact the right thing. Similarly, you see that in terms of businesses as well, in terms of how that money gets used. So once money's got a cost, then folks take a little bit deeper analysis on it. Similarly, especially because if the money market's paying 5%, well, then you're like, wait a minute, why am I going to take a chance on something that, might have a lot more volatility? So the whole mindset, I guess, if you will, really changes when you start to see interest rates as high as they have. And it's a very different mindset, and it's one that we haven't seen for 20 years. I mean, stop and think about those numbers that we're sharing with you on the program. Mortgage rates, 7.5%. 30-year fixed rate, 7.5%. Haven't seen that since November of 2000. So some pretty big changes, particularly in terms of interest rates. The other things that folks need to kind of remember is that an interest paid is not the same thing as a dividend. Not only is it not the same thing as a dividend, because first of all, interest paid is generally paid by virtue of an underlying loan or note. Contrast that with a dividend. A dividend is paid out of the profits of a company based upon ownership of stock. So interest typically associated with kind of a debt instrument, and dividends typically associated more with equity ownership. So the tax rate on dividends much less than the tax rate on interest. Interest is taxed as ordinary income. So what that means is that if all of a sudden you're starting to have more interest, then that means you're going to have an impact on your taxes. And the reality is that when you have interest, so let's say you've got a bunch of money sitting in the money market, or you've got some CDs or whatever the case may be, more often than not, there's not really any tax withholding that is happening on that. It's not like you're taking money out of a retirement account and you say, oh, go ahead and take 10% withholding and just take care of that and send that off to the IRS and we're all set. The reality is it's not really an easy way to do that. So if you've got $50,000 in a money market and the interest on that is $2,500, well, then that's about $600 more in taxes. Not only that, but certainly there can be some situations where the tax impact on that additional income can certainly have some major ripple effects, right? Maybe it triggers more of your Social Security to be taxable. Maybe if you're in a higher income tax bracket, it triggers the net investment income tax, which is an additional 3.8% if you've got above $250,000 of income as a married couple. So the extra interest can really create some bigger ripples. So here are, I guess, the three key things that we would say to really kind of take a look at, right? Make sure that you, of course, recognize the tax implications. Interest is taxable as ordinary income. Dividends, meanwhile, taxed at much lower rates. So if that's the case, then number two, you want to take a moment and sort of review where you are at, right? How much additional interest are we talking? What's going to be the ripple impact on my taxes? Because that may mean that you adjust your tax withholding. Maybe that's on your W-2. Maybe that's on your pension income or the amount of money that you're taking out of a retirement account. Or if you're paying quarterly, and we just spent some time this past week with a couple of different folks where we were talking about their quarterly payment. So if you think about your quarterly tax payments that you make, at this point in the year, in August, you still have 2 to go, right? So you've only got half of them behind you for the year 2023. So still an opportunity to sort of adjust those quarterly tax payments. And so you may want to consider doing that in order to get in front of the potential of a higher tax bill, particularly if you've got a bunch of interest that's coming into your return for the first time in a number of years, or for that matter, and this was certainly the case of one of the folks that we visited last week, there was a death in the family. And so that led to a certain amount of assets sort of getting shifted over into their names, and there was some tax consequence on it. And so in that situation, to kind of look at and adjust the tax situation is certainly makes a lot of sense. And then lastly, as we've been talking about, the interest is taxed as ordinary income. The dividends are taxed at a different rate. So certainly some things to be thinking about, sort of that good news, bad news when it comes to interest rate. I want to take a moment as we slide to the break to thank some of the folks who shared some comments on last week's show. Had some folks that shared some personal stories with me about personal property and what happens when somebody passes. We talked about that at length last week on the program. Certainly appreciate those comments and feedback. If you're interested in sharing those with us, just go to our website and reach out to us through our contact page at nelsonfinancialplanning.com. This is Joel Garris of Nelson Financial Planning, and you're listening to Dollars and Cents.